Have you ever placed a trade, felt confident it was a winner only to watch the market move against you, stop you out and then immediately reverse in your original direction? If this sounds familiar, I want you to know you are not alone. This is a common experience for many traders. It often feels like the market is personally out to get you. But what if I told you this isn't random? What if these frustrating moves are actually calculated and intentional? This is where the concept of market manipulation comes into play. Not a secret society, but large financial institutions, or smart money moving the market to benefit them, often at the expense of retail traders. Understanding this concept is the first step to leveling the playing field. Market manipulation means deliberate actions by large players to influence price. Learn their playbook. Stop being the victim. Start using these moves to your advantage. So let's talk about one of the most powerful tools in the smart money playbook, the liquidity grab. What exactly is it? In simple terms, a liquidity grab, also known as a stop hunt, is a deliberate price move designed to trigger stop-loss orders at a specific level. Imagine a very obvious support level where many traders have placed buy orders. Where do you think they place their stop-losses? That's right, just below that support level. That creates a huge pool of sell orders. Stop-losses sitting there, waiting. For large institutions wanting to buy a massive amount, that pool is a goldmine. They can push price down just enough to trigger those stops, absorb the selling pressure, and quietly fill huge buy orders without spiking the price. Simple analogy, think of a big shark in the ocean. Chasing single fish is inefficient. A school is ideal. In markets, retail traders are the small fish and their stop-loss orders are the school. Smart money is the shark. So you often see price pierce a key level by a few pips then reverse hard. Not a failed breakout, a liquidity grab. These grabs happen at predictable chart locations because retail traders act predictably. Now that we understand liquidity grabs, let's talk about the setup. How does smart money convince traders to place their orders at these predictable levels in the first place? This is where inducements come in. An inducement is a price pattern or a small attractive move designed to lure traders into entering the market prematurely. It's the bait on the hook. It looks like a perfect textbook setup, encouraging you to take a position right before the market makes its real move in the opposite direction. The inducement builds the liquidity that will later be grabbed. Let's use an example. Imagine the market is in a downtrend, making lower lows and lower highs. Then the price starts to pull back. During this pullback, it forms a small minor swing high. Then it continues up toward a more significant supply zone. Many impatient traders see that minor swing high as weakness and jump in short. They place stop losses just above the minor high. That minor high is the inducement, created to tempt early sellers. The market continues the upward pullback and takes out the stops above the minor high, grabbing liquidity. By learning to identify these deliberate traps, you avoid being the trader who provides liquidity. Wait for the inducement to be taken out, confirming smart money's intention, then look for your entry. If you've spent any time in the trading community recently, you've likely heard of smart money concepts, or SMC. Traders who follow this methodology are absolutely obsessed with liquidity grabs and inducements, for a very good reason. For them, these are not just market phenomena, they are the foundation of their trading strategy. SMC is built on tracking the footprints of institutional money. Instead of relying on indicators like RSI MACD, SMC traders focus on price action to find where institutions accumulate and distribute positions. Liquidity is the fuel that moves the market, and SMC follows that fuel. Those concepts train the masses and create predictable retail behavior. Concepts like order blocks, fair value gaps, change of character are tools to interpret the market narrative. An order block is the footprint of a large institution's order, but becomes a high probability entry only after liquidity is taken. An SMC trader waits for price to sweep a previous high or low, the liquidity grab, before entering at a nearby order block. The grab confirms smart money stepped in, loaded positions, and is ready to move price. This obsession seeks higher probability trades. By waiting for a liquidity grab and an inducement to clear, the trader gets confirmation institutions are involved. Patience and discipline help avoid common retail traps. They don't enter on the obvious breakout or the first sign of reversal. They wait for the fake move first, then capitalize on the real move that follows. Liquidity is the central pillar of their strategy. Now let's get practical. How can you actually spot a liquidity grab on your charts in real time? It's not as complex as it might sound. It requires a shift in how you view the market, but with practice, it becomes second nature. Here is a simple step-by-step process you can follow. Visual. Step. Mark swing high, visual. Price approaching, visual price sweeping above with a long wick. First, identify where liquidity is resting. Pull up a chart on a higher time frame, 4-hour or daily. Mark the obvious swing highs and swing lows. These are your key liquidity pools. Step 2, watch how price approaches the level. Don't jump in. Observe behavior. Often it consolidates or forms a small tempting pattern just below a key high or just above a key low. This is the inducement phase. You need to see price trade above the swing high, or below the swing low. This is the sweep of liquidity. A true grab is a quick surgical strike, not a sustained breakout. Step 3, look for confirmation. Pierce then reverse and close back below or above the level. Long wick =, stop hunt. Patterns, Judas swing, turtle soup. Step 4. After sweep and rejection, find your entry. Break of structure on a lower time frame, order block or fair value gap. Inducements are the silent partner to liquidity grabs. They are arguably more deceptive. They prey on good trading habits applied at the wrong time. The trap is so effective because inducements are designed to look like high-probability setups according to conventional trading wisdom. A trader who has diligently studied chart patterns will see what looks like a perfect double top head and shoulders pattern clear break, and retest of a minor structure. They follow their rules, take the trade, and feel confident in their analysis. This is precisely what smart money wants them to do. The trap is sprung not because the trader is bad, but because the setup itself was a fabrication. Let's break down the psychology of the trap. The market creates a small, clean swing point. For example, a pullback low in an uptrend. This is the inducement. Traders eager to join the uptrend see this as their chance. They enter a buy order and place their stop loss just below this new low. Now their position is part of the sell-side liquidity pool. The market then makes one final push down, just enough to trigger all the stop losses below that inducement low. This creates a double whammy. Early buyers stopped out and new sellers enter, adding sell-side liquidity with shorts. Institutions who wanted to buy now have a massive pool of sell orders to absorb. They can fill huge buy orders at a fantastic price. With opposing sellers cleared, the path is clear for a significant rally. Traders caught are left confused, wondering what they did wrong. Avoiding these sophisticated traps doesn't require a complex algorithm or secret indicator. Discipline, patience, a slight change in perspective. The first and most powerful trick is to always trade with a higher time frame bias. Start your analysis on the daily chart or the 4-hour chart. Identify the major swing highs, swing lows, and the key supply and demand zones. This gives you the market's macro narrative. A tempting setup on a 5-minute chart might be leading you directly into a major daily supply zone, a place to be looking for sells, not buys. Stop trading obvious breakouts from clean highs and lows. Wait to see what happens after the break. If it breaks and quickly fails and closes back within the range, that's often a liquidity grab. By waiting for confirmation, you let other, more impatient traders test the waters for you. You might miss moves, but you avoid countless fakeouts. That's a worthy trade-off. Third, you must redefine where you place your stop loss. Stop placing it in the most obvious spot. Instead, consider placing your stop based on market structure, below a more significant swing low, or give the trade more room to breathe. Better yet, wait for the liquidity below the support level to be swept first. Once the grab has happened and the price has reclaimed the level, you can enter with a much safer stop. Finally, learn to identify and ignore inducements. Resist the urge to jump into small breaks of structure or tempting pullbacks. Ask yourself, where is the real liquidity? Look for significant, unmitigated swing points on the chart. The small intermediate move is likely the inducement designed to build liquidity for a run on that more significant level. Wait for that level to be taken out. By being the trader who waits for the trap to spring on others, you position yourself to trade with the institutional flow, not against it. Patience is your greatest weapon. While the core of SMC trading is based on pure price action, there are a few tools and indicators that can help you visualize these concepts more clearly. These tools don't make decisions for you, but they can speed up your analysis and help you spot liquidity and inducements more efficiently. One helpful tool is an indicator that automatically marks swing highs and lows, often called a swing high-low indicator, fractals indicator. This helps identify major liquidity pools without manually scanning and drawing lines. Another useful tool is a session range indicator. It draws a box around the high and low of major trading sessions. These session highs-lows are often magnets for price. For visualizing inducements, many traders use indicators that highlight order blocks, fair value gaps, and imbalances. An order block indicator identifies the last up candle before a down move, or vice versa, that led to a break of structure, highlighting a potential institutional point of interest. A fair value gap indicator detects and draws boxes on large inefficient candles that signal institutional buying or selling. While you should learn to spot these yourself, using an indicator early can train your eye and confirm what you see. Finally, don't underestimate simple drawing tools. Your horizontal line tool and box tools are your best friends for marking liquidity levels. Manually annotating your chart forces active engagement with price action rather than passive reliance on indicators. Use risk-reward tools to plan trades, ensuring you only take setups with a favorable ratio, crucial in SMC. The goal isn't to clutter your chart with dozens of indicators, but to use a select few that clarify the story price already tells. Practice drawing, use a few visual tools to speed analysis, and manually annotate charts to train your eye. Active engagement beats passive indicators every time. So, we've journeyed deep into the world of liquidity grabs and inducements. We've uncovered how the smart money engineers market moves and how they use seemingly perfect setups as bait to trap unsuspecting retail traders. The key takeaway: the market is not random. It is a highly structured arena where large institutions hunt for liquidity to execute orders. Your job as a retail trader is not to fight this reality, but to understand it and use it to your advantage. Stop being the fish and start learning to think like the shark. The path to trading smarter begins with a fundamental shift in perspective. See highs and lows as magnets for price. Instead of jumping on the first setup you see, treat it with suspicion and ask, could this be an inducement? This cautious, analytical approach will save you from countless losing trades and improve consistency. Mark liquidity grabs and inducements on historical charts. Backtest and practice in a demo account. This backtesting will build your confidence and train your eye. Then move to a demo account and try to spot them in real time. Don't risk real money until you feel comfortable. Remember, this is a marathon, not a sprint. By learning to read the story of liquidity, you are equipping yourself with a timeless skill that will serve you no matter how markets evolve. Trade safe, trade smart, and I'll see you in the next one.